Welcome to episode 42 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with somebody I know pretty well. Sam Turner has been on Acquiring Minds twice. Today, we got him in the hot seat for the Minds Capital podcast. Nicholas, what did you think of our conversation with Sam?
Did you just say this was episode 42?
Yes.
Yeah. Is
Wow. I think it is. Yeah, it just really hit me when you said it. That's a lot of stuff we've been producing this year. Well, Sam Turner, yes, great guest from the UK. And one little segment that I enjoyed in particular was when he broke down what a typical deal looks like when he's doing add-ons. And so he's buying very small add-ons. In some cases, he's able to buy them for 3.5x. And I asked him, so how do you finance them? And he said, well, he can get 2.2x from a senior lender. This resonates. Typically, senior lenders for cash flow-based loans in the lower middle market tend to land somewhere between 2 and 3x. Then he said it'll be a 0.7x of seller note, perhaps, and then another 0.7x of equity. And that'll be it. And when you only need 0.7x of equity, he says, I can get that out of the operations from my cash flowing business. And so this is how you create a compounding acquisition machine, in that you can use leverage and internal cash flow to fund acquisitions. We've seen this story also with some of the deals we've invested in at Minds Capital, especially if they're conservative on the front end. So let's say they, for simplicity, go all in, all equity up front. That means, and let's say the platform was $4 million of EBITDA. That means that if they want 2x leverage down the road, they can get $8 million on the basis of the platform, notwithstanding any growth that may happen organically. And then for the add-on, let's say that's a $1 million EBITDA company, they can get at least $2 million there as well. And so you can see how debt can be a very effective instrument for people like Sam and in platforms when they do add-on acquisitions. And it was just fun to hear how he broke it down like that.
It is impressive what he's built to and how he has structured this. Even more impressive when you consider that his first acquisition, platform acquisition, if you will, these are all small deals, and he talks about buying too small. So I hesitate to call his first acquisition a platform. But that first one was pretty much a disaster and has all but gone to zero. And he has still managed to acquire and grow his way to, I think, about a 30 million pound run rate. Not only did he save and grow the business with these 3 other acquisitions, but he had also launched an entirely new business line in facilities management that I think it was early last year. So in less than 2 years, he's gotten that business to 1.2 million of EBITDA. So 1.2 million of EBITDA, net new EBITDA, no debt on that EBITDA from a standstill. So I think it's all a testament to Sam's abilities as an entrepreneur, really, that he was able to come back from a very painful first acquisition, build an entirely new, very profitable business line, and continue doing 3 more acquisitions and presumably many more to come. What do you think, Max?
Yeah, impressive that he's been able to hang in there. And it's really a testament to him being a strong entrepreneur. And, life and business often can be very challenging, and it's, inevitably things are going to happen in business, and it's really a matter of how do you deal with them and how do you persevere. And I think that, so far that's a great story for Sam. What I liked in this episode is kind of a little different and somewhat out of left field, but it's actually something that I think about a lot related to just life and business, and as individuals become successful and achieve goals, I often wonder sort of what's next for them. And I think, Will, you asked Sam about his sort of deeper purpose in life, to which he shared some information that he he sees wealth creation as a part of his journey, but ultimately wants to give back and is very focused on philanthropic initiatives. And in the meantime, is giving his time on either a weekly or a monthly basis to people, just giving out his expertise and his time to help others in business. And I think that's just very commendable and extremely important. Just to share that knowledge. If you can't share the money at this point, certainly share the knowledge. That's just as valuable, if not more valuable. But ultimately, as individuals accomplish their goals, in wealth creation, I think, especially in independent sponsorship, that's sort of like the main goal for most of these folks. But I think as they accomplish that goal, I would be willing to venture a guess that most of these folks tend to then start thinking about, well, what's next? I want to take care of my family. Well, now there's even more resources that I need to do that. What can I do beyond just taking care of myself and my family? And I think it's an interesting question, and it was good to hear that he has a plan and a purpose. And I'd love to hear sort of from others what their plan and purpose is as they begin to accumulate wealth and sort of reach the later golden years of their life.
It is a strong why for Sam. He talks about it at more length in one of our Acquiring Minds episodes. So he set out on this venture to build Advantos with a particular number, his number of wealth that he wants to earn for himself from this project. And that number is based very much on what he then wants to be able to go do in Thailand, which is a country that he has a lot of strong connection to. He spent many years outside of the UK in Asia and has a really strong connection to that country. And actually, he was taking his father there for the very first time. Well, he's on his trip now. He squeezed in an interview with us before taking his dad to see Thailand and presumably to these communities that he hopes to bring some of the wealth that he's generating now to. It was a very timely that we caught him when we did. And I agree with you, Max, that this sense of purpose is not one that we encounter a lot in this world. And so it was very refreshing to hear from Sam. Before we turn to the episode with Sam, we have some hot off the press data from GF Data. Don't know that we've had much time to digest it, but Max, I think you took a quick look. Did anything jump out at you?
It did. And like you said, I want to spend more time with this and then talk more about it next week. But the metric that jumped out at me right away was deal count. And deal count through September of 2025 is actually down 27% compared to the first 3 quarters of 2024. So we were seeing that trend in the last report through Q2 of GF Data, but that now continues into Q3. So, interest rates and other uncertainties in the economy are cited in the report for the decline in deal count. But it is down fairly significantly in the lower middle market through Q3 2025. So that's not inconsistent with sort of what I'm seeing at the accounting firm. It is not the full court press that we often see in the third and fourth quarters this year. It's steadily busy, but it's not the craziness that we've seen in the past. So I'm not surprised by this metric, but it's nice to see it. It's nice to see it quantified.
Yeah. Well, GF Data is a partner of ours, and they send us their quarterly data. We really appreciate that from GF Data. And you can find a link to their website, a special landing page for the partnership that they have with Minds Capital, and a special deal for those of you who request information via that URL. Check the show notes. And our usual reminder, Minds Capital is actively investing equity in independent sponsor deals. So if you are a sponsor with a deal under LOI, please submit it to us at mindscapital.co. And if you're interested in investing in Minds Capital as an LP, there's also a pre-registration form on our website for accredited investors. So if you are one, please fill out that form to be kept in the loop on our fundraising. And here is episode 42 of the Minds Capital podcast with Sam Turner of Advantos. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Sam Turner leads Advantos outside London, aspiring to be the favored service provider for M&E and F&M in the UK. We're going to have you define M&E and F&M for those of us stateside here in a second, Sam. You started in 2021 and you've acquired 4 businesses to date with the aim to reach £150 million in revenue by 2030. Welcome to the Minds Capital Podcast, Sam Turner.
Great to be here and good to speak again, Will.
Yeah, Sam, you've been on Acquiring Minds twice to discuss the origins and early days of Advantos. So to kick us off, can you bring us up to speed and provide a snapshot of where Advantos is today, please?
Yeah, sure, Will. So as you mentioned, we're now 4 acquisitions in. We started the journey almost 4 years ago now, was with the first acquisition. So we're 4 acquisitions in. We're built to a revenue of about 30 million, about 35 million on a run rate basis, high single digit EBITDA level. And yeah, just coming back to the point around defining the sector. So M&E for us is probably the differences across the pond. M&E is mechanical and electrical. So HVAC, as you'll know, HVAC is a big component of what M&E is, but M&E is a slightly wider focus. So we focus on M&E businesses, contracting businesses that do maintenance work as well as project work. But we also focus on the FM business, which is facilities management business. So which is where you're taking, having a contract with a property owner to maintain all aspects of the building. We principally look after the hard services, which is more the M&E type services rather than things like cleaning and stuff like that. But so it's very much related, and we've got two arms, and one supports the other as well. So that's where we're at. But yeah, just trying to embed the systems and technology, which is a sort of core component of now what we do, and that's a little bit of a shift in terms of our kind of thesis around what's important and where value is driven from, and technology is going to be a bigger and bigger part of that. So we've just spent 1 year really putting in technology in all of the companies. So that's kind of why we paused the M&A front, and we're about to kind of start again probably early in the new year.
Great. Thank you for that, Sam. And I called it F&M. It's just FM. Excuse me.
That's fine.
Great. Now, Sam, just to also kind of define you and your overall project here, as you know, this is a podcast for independent sponsors. Independent sponsorship follows a pretty consistent format. Yours is a little bit different. You're kind of in between ETA and independent sponsor. So give us kind of the picture of what you're trying to build and how you approached it as an entrepreneur, as a builder.
Yeah, I guess I would say, Will, to that point is, I don't have a PE background. I've got a finance background, but have operated in the sort of corporate space in the travel industry, so completely different to what I'm doing now, but in sort of large global travel firms around the world. So, yeah, not a PE background, but effectively what I wanted to do was, as I came out of that, I decided I had enough of that. I wanted to build a group of companies, leverage what I'm quite good at, which is, I think, operating a little bit in the finance community, so dealing with investors, dealing with lenders, etc., but also working quite closely with business owners, and that's what I've done in my sort of career to support when I run commercial teams as well, supporting SMEs, supporting founders of businesses to grow their business, and that's what I wanted to do. I probably not sort of, I didn't sort of put myself in one box or another, so you can sort of use the labels more than me. But what I've done is effectively is thought about, which is the sorts of industries that I wanted to be in. And I've some of the usual characteristics around large fragmented industries because I wanted to build a group. A little bit resilient to the technology disruption factor. So it wasn't going to be disrupted by technology tomorrow. It's got some tailwinds. And I landed in this kind of space that I thought that's quite a good one to tick many boxes. Also things like the arbitrage opportunity in this space. And know you shouldn't always count on that arbitrage, but part of the value creation for us is absolutely the multiple arbitrage that exists in our space because of the pyramid of businesses. So just to give you some context, we're something like 45,000 businesses in the UK in that space. There's quite a large number of businesses, but most of them exist on the way too small kind of level. But you've got still, as you move up that pyramid, you've got a nice arbitrage between where I'm sort of acquiring at and where we hope to get to if we can do a bit of integration along the way. So there was that kind of value value creation opportunity through the arbitrage. So what I've done is I had a bit of capital myself from my corporate career. I've got some investors that are all within my network, or were all within my network. I've got one now that was sourced elsewhere. And I just went sort of deal by deal, so I didn't sort of really understand also the world of the kind of what was a kind of search fund or anything at the time. It was really like looking at, well, let's just buy my first deal. I had some experience around buying companies in my corporate experience when I was FD of a business. So kind of started that way and then just sort of navigated around. So where we're at now is we've done the first 3 deals we did on a deal by deal basis, with myself investing alongside what you'd call LPs, but effectively a handful of investors. They're not massive deals, so we've only spent I think something like 6.5-7 million on the 4 deals, so relatively small size deals, and we're now trying to kind of scale that up going forward. I took most of the equity. I didn't have a prescribed format for that, which again is different to, if you like, a typical kind of search fund economics with your investors. It was just a case of me pitching investors on what I was prepared to give away, what I thought was a reasonable return based on the business case, and I got traction on that. And maybe actually I gave some of the equity away, maybe slightly too cheaply in hindsight. But what that's allowed me to do is keep the majority of the equity. So we own about 70% of the group, with the investors owning the remainder 30%. That will get diluted a little bit because we'll want to bring some management on in terms of share options as well. So that will get diluted a little bit. But that's allowed me to keep complete control. The investors I have are all, as I said, they're all sort of part of my network. They're not chomping at the bit. They're not ringing me every day saying, where are we with this? I did have some additional investors initially that were not really aligned with my sort of long-term capital kind of approach, and I subsequently have bought those back out personally to kind of simplify the cap stack, so to speak. So that's where we're at really. It's a little bit, and we use the term on the pre-call, a little bit probably scrappy in terms of where we're at, and we've been refining a little bit the thesis, refining the strategy along the way. But what's important to me, Will, is the flexibility. So again, coming from a corporate career where I was, traveling around the world, but on somebody else's, clock, so to speak, in terms of having to attend meetings from morning till night every day, not seeing the kids, etc., etc. So flexibility and actually doing things on my terms is critically important, and that's absolutely what I love about what I'm doing. One of the things I love about what I'm doing is I have that flexibility. And we could talk more around where do I want to go from here and what's the right time to bring institutional capital in. But we will wait as long as we can before doing that to enjoy that period, let's say. And I think there's a great opportunity, again, given the dynamics I discussed around that pyramid in the UK, where the market is, the number of opportunities that there are, using a surplus cash plus a bit of debt kind of model going forward. There's a great opportunity to get a great return on equity. We just need to kind of scale that now from now, once we've got, almost like the platform with the technology and stuff sorted.
Sam, I want to congratulate you, first of all, on building a business that gives you the flexibility you sought. Huge victory in and of itself. Also, retaining 70% ownership of this project is mostly unheard of, except in what we'll call this side of the pond, SBA, self-funded style deals. So you don't see that in traditional search funds. You don't see that in traditional independent sponsor type deals. So you said that maybe you sold the equity too expensively, but that's not how it lands to us. You mentioned debt. Is there any debt yet? tell us what the role of debt here plays so far and looking forward.
Yes. So the logic is absolutely. It probably started with put as least amount of equity into the deal as possible, which maybe again over time we've refined that a little bit, and our thinking is keep the leverage under control. So we'll always look at having trying to have a gross leverage of kind of three times maximum, and a net leverage of 2 times maximum in terms of where we're headed. But in terms of the deals to so far, I mean, to give you a bit of a breakdown of that. So probably on average we've spent again, they're not massive deals. They're on average sort of 5-6 million revenue, on average 500,000 EBITDA. So just to give you some context, they're relatively small deals. We're kind of now wanting to do larger ones as we move forwards. But the kind of the breakup of that. So we were paying around about 3.5 times, let's say just under, but with fees etc. about 3.5 times, and then the makeup of that is probably about 0.7, something like that, turns in equity. Similar amount in sort of seller financing, as you'd call it, with deferred consideration, as we would call it, and the rest in commercial debt. So about 2.2, something like that, to get to kind of the 3.5, 3.6. So that's kind of where we stand on average across those 4 deals. We've refinanced the debt once within that period of time as well. So moved from one lender to another. Moving forwards, we would be probably looking to pay a little bit more, so 4 to 4.5 times in terms of the deals that we're looking at. On average, we're looking at deals around about the 10 million revenue, 1 million EBITDA level. In the UK, the minute you could sort of go over the 1 million EBITDA, the kind of multiple starts to tick up a little bit. So it's the kind of just underneath that to kind of get the maximum or the least risk in that business, the biggest amount of, let's say, infrastructure with that business and quality in that business, but for the kind of paying the multiples at the kind of 4.5 times. And we'll be looking at using surplus cash for a lot of that. So the model is to recycle surplus cash. And that would probably be sort of 1.5 times in surplus cash, 2 times in commercial debt, and a similar sort of seller financing component. We do have earnouts on top if the founder remains with the business, and then there's clearly the earnout that sort of runs on top of that, but that's kind of self-financed by the growth component within that. On the last deal, and something we will consider going forward, is we have asked the seller to roll some of the proceeds into the group. So they have received some shares in the group. Not a huge component, but that is something that we will look at more and more going forward.
What prompted you to do that in this deal? And you hadn't done it in the previous 3, you did it in the 4th. Why?
It's a good question. So I think the key reason was we ended up with a bit of a gap from a value point of view in terms of getting that over that hurdle. And we didn't want to finance anymore. We didn't put any more cash on the table. We wanted this guy to be part of the group going forward. We wanted him to play maybe a bigger role in the group going forward. And therefore, we just felt that was the kind of right thing to do to kind of bridge the gap, not have to finance anymore, and give him a little bit of equity in the group. As I said, it's not a huge component, but it's something that as the equity value grows, I'm more inclined to do more and more. Obviously, as the equity value is relatively low in the early years, you don't want to dilute yourself too much by doing that. But that is certainly a tool that we'll use going forward. But that's the broad kind of makeup of the deals. So we have a very kind of supportive debt partner who's along for the journey, understands what we're trying to do, and very supportive in that.
What kind of lender is that? Is that a commercial bank or regional bank?
Yeah, so it's a debt fund. So a debt fund, more of a kind of regional debt fund, and that's the kind of entry level, if you like, in terms of these deals before you get into more the challenger banks and the high street banks. So we banked with one of the high street banks, one of the kind of big players. They weren't interested at this level, and they said maybe next time. So maybe in a couple of years we can go back to them. But yes, that's they have a little bit more appetite. The debt funds, and there's a few of them in the UK. They have a little bit more appetite for risk funding, the kind of SME world. But obviously, you're paying a little bit of a premium for it.
What's the premium you pay?
So in our case, we are paying, and bear in mind, we refinanced the group debt. So we took the amount that we've got in a term loan back in December 23. So possibly the worst timing from where interest rates were as well. So from a financing point of view, at the peak, we got a fixed rate of 11% interest. So just to give you some context, but at the same time, the kind of challenger banks were offering somewhere in the region of 8 to 9. So it wasn't a huge difference, and the high street banks maybe more like 7. So again, not. Yes, that's a big difference, but then when you look at the rigor behind there, how sort of strict they are on some of the covenants and the lack of flexibility, we went with the debt fund.
And 11%, is this a 5-year term?
Yeah, so that's the other thing. So most of the debt available for SMEs and to do the kind of the acquisitions we're looking at, most of it's available at on a 5-year term basis. Mostly, again, most of the debt funds and even the challenger banks are looking to amortize most of that from day one. You might get a 1-year interest only period. In our case, we managed to get what really suited us, which was 100% bullet on that. So there's no amortization across the 5 years, 100% bullet. In addition to that, we got some of the interest is paid and some is paid in kind, so that gets rolled onto the loan. So we pay that in the 5 years.
So out of the 11%, only let's call it 8% is cash today, and 3% rolls onto the balance sheet and will be paid as part of the bullet at 5 years. And you said that the debt you have structured at 2.2x EBITDA for your add-ons, roughly, give or take.
Yes, roughly, yeah.
And do you see that number coming up as the group grows? And how high up do you think a typical lender will get in the lower middle market?
A little bit higher than that. Well, obviously, we didn't want to max out. I think the bigger you go, the more aggressive you'll get to, and you'll get 3 times probably on the sorts of businesses we're looking at, but not a great deal more than that. And for us, we wouldn't really want to be more than that anyway, in terms of the kind of the leverage ratios. It starts to get a little bit scary.
And then on the equity side, you mentioned that you retained 70%. How much of the equity did you put in to date?
So equity wise, I probably put in a third of the equity. So it's a decent amount, or a decent proportion.
But hence to what Will was saying, that overall, these are terms. It sounds like your effective carry then is fairly high if you put in a third, but you own 2/3 effectively, right?
Yes. I think the point, how I sort of structured the pitch to investors was more around, look, if you believe this business case, here's the kind of MOIC and here's the kind of IRR available, and you've not got to believe much to kind of make this kind of make sense. And it was a fairly conservative case. And that just kind of worked out as it was, and then I took the rest of the equity effectively. So that's what we did. And I think from memory, we were sort of suggesting it was sort of business case anywhere between 4 and 8 times on the MOIC. But that was before we then had a greater plan around then the sort of long-term acceleration of the group, because we were much smaller. If you remember, Will, sort of much smaller sort of context of, or ambition, if you like, when we started.
As you look at add-on targets, you said that they've been around £500,000 of British pounds in EBITDA when you've acquired several of them. What would you say is the lowest that you could go in terms of just operationally, that it's worthwhile your time, and also that the lender would want to spend time on an add-on acquisition in terms of size?
The lender now that we have would probably go a little bit lower if we could demonstrate that was strategically important to us. Like there was a specialist service that came with that, and there was a kind of big upside. But if it's, let's say, an additional player and it's just one more business to add to the group, then it would be minimum of the $500,000. But in reality now we're looking at we're trying to go a little bit further north of that. The model that we have and the plans we have are almost a kind of a self-finance, non-dilutive model where we continue to use the surplus cash, we continue to partner with a little bit of debt, deleverage over time, and that gives massive returns if we're able to execute on that. But that assumes that we're doing slightly larger deals, but not massively larger.
Because if they get massively larger, the valuations go up quite a bit, and then you need so much equity that it's hard to fund it out of cash flows.
Exactly right.
And so how do you weigh this? And this is a big question for every entrepreneur, right? How do you weigh going slower and using your own cash versus, in your case, there is this whole menu and runway of add-on acquisitions that are available, and maybe this space won't exist or stay so fragmented forever. And there is an argument to be made for going fast, but for that you need institutional capital, which is dilutive. So how do you weigh that strategic choice on an ongoing basis?
No, it's a great question. It's a question I sort of wrestle with my with myself on an ongoing basis. I think where I've got to with that is we've got to get to a point where for us, we've built the equity value to a certain level before diluting, and what, despite we've got a sort of long-term plan, we would look at, and the current thinking is we would take some institutional capital in a couple of years' time, assuming that we can get to the kind of 5 million that we've got penciled in for the year after next in terms of our plans. If we can get to that level, then it makes sense to bring some capital on, and therefore, I've been in sort of constant communication with a number of potential investors that would want to get in. But you're right, because for me, it's starting to heat up a little bit in the UK as well. There's lots of or an increasing amount of private equity money now coming into the space, which is pushing the multiples up at the sort of upper end, which is nice because the kind of valuations are nicer going forward. They're still not looking obviously at the size of deals that I'm looking at, but anything sort of north of 2 million is where that kind of institutional money is coming into.
Can I press you though on the 5 million in EBITDA is when you thought it made sense to go to look for institutional or to refinance with institutional, recapitalize? Why there though? Why not a 3 million? And I'm leading you a little bit because I think I recall from our Acquiring Minds conversations that part of this is also you've got a personal number you want to hit. So is it driven by the personal number that you want to be able to take off the table?
It's two things, because you can also argue on the other hand that it's not that you're going to get less out of it if you take on institutional capital. You'll have a smaller share of a bigger number. I get the logic. For me, it's partly being the master of your own destiny for a period of time. And knowing that actually we can get to that number relatively quickly. It's not too far away if we can get 2 or 3 things landed that we're working on now. That is achievable. So I think kind of a 2 year from now kind of time frame, 2.5 year is okay, is acceptable if we can sort of reach that. I wouldn't want to do it beforehand because you'd just be giving up too much. The second point is the point I made at the beginning. The minute you take on institutional capital, the game changes in terms of who you're working for, despite if it's a minority or not. Effectively, the game changes a little bit around the flexibility you've got, the decision-making capability you've got, just the feeling and sense that you've got. So for me, that's part of it as well. It's the two things combined.
But is there anything about institutional capital that is, accretive in the sense that they're strategic, they have resources?
Yes, there is. But I mean, the conversation that, for example, access to debt financing at much better terms would be one, right? So that's one straight off the bat. I think all of them will pitch that they can help with the value creation side, which, having discussed the details with many of the partners, etc., I'm not overly convinced on that there's going to add too much value from that perspective. Secondly, the deal sourcing side. Again, I don't think there's a huge amount there that we need. The minute we kind of press the button to get more deal flow, it will come. I've not got an issue with regards to that. So there probably is a little bit, Nicholas, but not a huge amount. So for me, it would be just the capital is the constraint to grow more quickly, and then comes with that the increased governance and stuff that maybe we don't want.
Sam, can you tell us a little bit more what you mean when they say all of them pitch that they will chip in the value creation, but you are not convinced? What's the gap there?
So the firms that you speak to, whether it be family offices, which tend to be obviously a little bit more long term in their thinking, which is perhaps more along the lines of what we want in terms of capital. Although that's not 100% clear at this stage in terms of whether it's a forever hold or whether there's a clear exit. But whether it's family offices or private equity, they'll all pretty much say, well, most of them will say that actually they can help with, sourcing talent, for example. They can help with giving some structure and giving some, best practice around value creation opportunities, around structuring initiatives, around obviously the financing side and the debt financing, which I accept would be a significant advantage. But on the kind of strategic components, for me, these are things that I've kind of done to death from a corporate perspective many times, and having integrated businesses, having sort of run value creation plans for big PE as being the owners, let's say. I don't get the sense that there's going to be a huge amount of value add from that. And the other key component is the deal sourcing. And again, I think we could be networked enough and have enough capability internally, organically, to drive that whole flywheel without a strategic partner.
And so there's an element here that they talk the talk, but you're not convinced they will walk the walk.
It's not that I'm not convinced. I think I think I'm not convinced for us and for me. And I think, I don't come from maybe, and you guys are used to talking to more the professional XP guys, investors, etc. So, but if you're talking to business owners that have grown the business and they want to sell and whatever, but they've not managed a bigger business or whatever, which a lot of the discussions would be around that, I can see the value add. Right? Mm-hmm. They're not, they've grown the business to 30, 40, 50 million, but they don't know how to grow it beyond that. Well, frankly, at the moment, 30, 40, 50 million is in the roundings of what we should be used to looking at. And actually, I'm more comfortable the bigger it gets. So I think there's horses for courses. And I think, at the moment, that's not really what is going to add the value to me. What adds the value is the capital, yes. But am I prepared to give away the equity on the back of that right now? No, but I fully accept that there is a timing here that maybe in 2 years that maybe it's kind of the opportunity, the window is kind of going or closing or whatever. So I'm conscious of that, and I'm constantly sort of rethinking and challenging myself on it. But right now, that's kind of where I'm at.
Sam, the first business that you acquired was actually the most challenging, which, as I say that, actually would be logical. Your taste hopefully would get more refined as you go.
Yeah.
But give us just a couple minutes on that, how you've managed that and how it's driven the refinement of your thesis or how you look at targets.
Yeah. So the first business, initially, I was looking at the sort of sector that I'm looking at, but quite wide. And the first business happened to be, you would argue, within that remit, but it was more in the construction space. And what we do now is entirely in what we'd call the built environment. So we're not in construction anymore. We're in servicing and refurbing and replacing in the existing built-in environment, existing properties.
And so, Sam, this is a story of project-based revenue versus services, reoccurring revenue?
It's not just project-based. No, it's construction versus built. So, for example, a huge tower block in Canary Wharf in London, the whole plant room needs the new boilers, new equipment, new assets. That's something that we would look at, and that's a big job. It might be 500,000, 2 million, whatever the number is. But that's not construction, right? Construction is sort of ground up construction. And this was construction. And this was also in the new build residential space. It was very kind of specific, all of the heating and plumbing and air conditioning kind of requirements for those big sort of developments at the same time. Notoriously, the house builders are very aggressive commercially. So this didn't help. We were fixed into... as is the case, you're fixed into contracts that might run 2 or 3 years, which is fine. But when inflation then goes from 0 to 25 to 30 to 40%, you get trapped in that, and that caused us an issue. But to give some context, I think this business, yes, the market turned against us, but actually we paid the price of being too eager to get the first deal done, not doing the diligence around the people in the business and the culture and the management quality in the business, which was very poor. Placing trust in people that actually now I would see more red flags. So the former owner, set up in competition with us the day of the final deferred consideration He pinched the management, or pinched some of the management, he pinched some of the engine. So it was a really kind of difficult situation. And so there's some learnings there, and obviously we've refined that quite heavily in terms of the approach going forward. And that business effectively is now zero, or almost zero in terms of the P&L. What we did, Will, at the time we were seeing some challenges, we decided to pivot that business and actually create a more, let's say, built environment arm to focus on the area that we wanted to do. That business is growing incredibly well, and this business has come down. So we were talking a little bit on the pre-call, Nicholas. You were asking me about the sort of organic growth of the business and how that was doing, and I sort of I said around about 15%. I thought I'm going to just go back and check that. So the actual organic growth of the business for the average time held is 12%. In terms of top line growth. But if you take out the fact that this business was doing about 5 million and is now doing zero, it's actually 21% in terms of the organic growth of the business because of that. And that's driven by driving a whole new revenue line, by attracting talent and getting talent that people know, and actually being really intentional about that, which is fantastic to see. And that business goes from strength to strength. Secondly, professionalizing a little bit the sales pipeline of the business, because the group companies didn't have any professional, let's say, pipeline management, etc., for the business, and a little bit, I suppose, a little bit of market growth as well in that period. But that's kind of the numbers behind that organic growth, and there's some of the learnings that we've refined since. But it's a painful. It's been a painful time because we've lost money in that business since day one, pretty much.
And Sam, the new business that you spun up, that is the foundation of your now FM business, right? The facilities management, that was the new business that you spun up, and give us some numbers around the success there.
Yeah, so we started that in March 24. So our year runs from July to June. So in the first year, pretty much from July last year, we went from 0 to about just under 4 million in revenue and 500,000 in EBITDA in the first year, and that this year will be something like 9 million in revenue and about 1.2 million in EBITDA. So it's been massive growth in that area, and that's where the kind of run rate as well is bigger than the numbers that we've talked about. And that the other learning from that is really, when you acquire these businesses in an industry that you're not from, you assume that the kind of the talent in those, because bear in mind, we've come from a massive corporate, multi-billion euro corporate that has got McKinsey all over it, has got big PE all over it, and we're dealing with sort of, data into an SME environment where you ask for a P&L and there's almost a kind of question mark as to what that is. So the people component, you assume that that's what it is. But then when you hire somebody really good, and they turn out to be really good, the difference that makes is incredible. And what we've then done is said, right, let's go find more people that that from your network, etc. And that's how we built that team effectively.
So you found a superstar to run the FM business, to build up the FM business, and that person brought others.
Yeah, effectively. And it's our sort of COO that came in and has been instrumental in terms of the growth. So yeah, people and the importance of getting the kind of key senior talent on board is massive.
But how much of the original business number one that you bought that's essentially gone to zero, how much of that team has been retained and parlayed into the FM team? My impression was that some of those resources shifted over, but really one shut down and the other kind of started.
Pretty much. Even the support services for that business have gone because they were not good. I think there's probably one person out of a team initially of, 30 people, 35 people. There's probably one, maybe that's a bit harsh, maybe 2 or 3, including 1 or 2 engineers. So maybe 2 or 3 out of 30. So it really is a completely separate business.
That's remarkable. So just to underline this for the audience, your first acquisition, what people often call the platform acquisition, although you're not doing the exact kind of PE model, so it was a small business, but still, acquisition number one has essentially gone to zero. Your first acquisition has gone to zero, and you've had 3 others and spun up a new one, and here you are now doing well. Not that it's been, the story is yet to be written, but you've certainly emerged from that crisis and from a total donut on acquisition number one. Really remarkable.
And it's not been easy, Will. And there's been some really, as we I think discussed before in a previous podcast around the fetal position kind of moment. So it's been tough. But and at one point we put a little bit more money in as a shareholder loan, of which we've taken most of it back out again now. But so it's not been easy, but we're kind of now firmly squared on where we're headed, what the kind of strategy is, how we differentiate, what's our how we compete in the marketplace, how we're going to win. So it's a case of now kind of landing that for a couple of years, growing to that 5 million benchmark, which really is the kind of tipping point for where you get a big multiple, a big valuation uptick. And you see a lot of activity in that kind of 5 million plus space now. And the multiples that are being paid are 10, 11 times. I'm not saying we would be at that level, because the quality of the business probably wouldn't be quite the same in terms of the level of recurring revenue within that mix. But certainly at the kind of 8 to 9 times at that level.
Say that again for us, what you're buying at and what you think you'll be able to sell at in terms of multiples.
So we're I would say historically bought at kind of let's say all in including fees 3.5 times, and we would say going forward we'll probably pay up to 4.5 times on future deals. We're probably trading at 5.5, 6 in terms of the size and dynamics of the business where it is now. So there's a little bit of arbitrage there, but deals that are, so you get to 5 million, you got some basics of the characteristics that we need, and should be at north of 8 for sure. But similar businesses are going with a bit better quality around recurring revenues and stuff, are going at 10, 11 and 12.
In PE, it's said that the best way to save a bad deal is to do a good deal. And so how quickly did it materialize that your first deal was going to become a donut eventually? And did that create pressure or urgency for you to do more M&A sooner? And if so, did that pressure affect your underwriting capabilities or diligence or discipline, I should say?
Yeah, so a great question, Nicholas. So in terms of timing, we were already looking for the second deal at the time we closed the first. To give you some sequencing, we closed the first December 21, and we closed the second on July 22, and we closed the third on August 22. So that we were running two deals in parallel. But they were sort of 4-month periods. We were sourcing right from day one. If it hadn't have been for landing those second and third deals, we wouldn't have a business now. So that's kind of the beauty of diversification to a certain extent. I was a little bit surprised that my lenders were supportive of the kind of deal. In answering your question about how soon was it a donut, again, lesson learned, we constantly thought we could turn it around. And it was only sort of 6 months ago that we said, no, enough's enough. Let's just wind this kind of down and actually just, yes, it's going to be expensive. We're suffering from that a little bit at the moment, but we're not going to have the headache and the management headache going forward. I think we did a good job at communicating with the lender around why it was failing. There were some market dynamics that were literally outside of our control. So one, inflation was massive, and that really ripped into the margin of the business. And number two, the interest rates started to go up, and the housing market started to kind of collapse, which then drove the demand from the developers to go like this, and everything kind of softened at the same time. So that was why it was kind of almost a perfect storm in terms of the business. Where I was at fault, because I couldn't help the market conditions, where I was at fault is I didn't do diligence on the people, the culture, the quality of the systems, which were pretty weak and poor. And these are always the things that you got to get behind when looking at a deal, because they're never in the IM. If you're talking about much bigger businesses, maybe it's different, but in a small business context, these things are really critical. So yes, we took too long to recognize, but we did a pretty good job at convincing the lenders that it was mostly market driven.
And then you also mentioned there was a breach of non-competition, I think, by one of your sellers. How do you do?
It wasn't a technical breach. The first, I think, learning again from the SPA, I think it's the same terminology, the contract, we had a tie-in for the 3 years, but we also had, that was the time of the deferred consideration payments as well. So he didn't breach that. He literally set up in the background, went live within 2 weeks. within 2 weeks of me paying, let's say, the final installment. Bearing in mind that business had funded none of those installments as was expected to be. It was all coming from surplus elsewhere in the group. So that business has never made money. So yeah, painful experience, but one that you certainly learn from. If you can survive from it, then you can sort of take it on board and use it going forward. So we've changed the contracts as well now going forward. So we have longer period of let's say non-compete clauses post any deferred consideration elements. Yeah.
And Sam, anything to learn from the lack of diligence that you yourself describe as the problem there? Anything the audience can learn from that?
I think it was just sounds strange having done acquisitions before, but it was a kind of naivety that what they told you was the reality. And almost, I'm the type of person that wants to trust people, always sees the best in people, and I'm a very sort of people person, and that sort of integrity, which everyone will say, but it's in reality what you do to demonstrate that that's the case, right? So I'm not used to the kind of people being complete cowboys, for example, and that's naive, right? So you learn your lesson from that. And it was my bad completely. I just assumed that what he was telling me was the right things, and yes, it was just poor on my side. I didn't dip into it. Now, it is always difficult. Many times, it's difficult to get behind the seller to actually speak to any of the management team to really understand the quality that they've got there, to really understand what that culture looks like. But I should have. In hindsight, there was plenty of red flags that I didn't pick up on. So it was lazy. And it was naive, I would say, on my behalf, being honest.
The point about being naive, let me pull that back to the question on finding a rock star. You have a superstar on your team, and who it's probably hard to quantify the ROI, but when you're hiring, for us who are a little naive out there and gullible, how do we distinguish between a true superstar and someone who's going to be pretty good, but not quite take the organization to the next level and have that kind of Moik level impact?
Yeah, I think there's no silver bullet to this. Clearly, what we'd done. So we've also got a young CFO as well in the group who was an excellent hire, and what we've done for any of the group hires, we've got myself plus 4 executives at a group level. So we're almost over-invested now at a group level, and then you've got MDs running each of the businesses. So we've got that kind of infrastructure ready to grow. But for each of the group hires, we've done a profiling on there's a acquaintance of mine who owns a business that specializes in this kind of profiling behaviors, values, energy levels, and actually sort of mapping that was important as well. So good example, my CFO is complete opposite of me. Despite I'm a qualified accountant, he is the complete opposite of me. So I hate any of the detail. He loves the detail. He's not the first person I would go, no, let's go for a beer, but he's brilliant at the job he does. Now, if it wasn't for that profiling tool, I would have actually hired somebody else because I was leaning towards somebody else. Now, so that was a little bit of rigor in the process of making sure you're getting the right position, because it's not just about skills, experience. It's also about the kind of values, attitude, and the energy levels that they have doing certain things. There's no good hiring somebody that's big up here and you want them to really kind of be sustaining and get the job done and do that. So I think that's an important watch out for people. But then what I also did was manage to speak to a couple of references before we hired. And I think I've never really bothered to do that in the past, which again, maybe is naive, because I think, well, I've seen the person, I've met the person, but both of those people that I spoke to couldn't say enough good things about him. So that for me was compelling. I also got my non-exec advisors. So I have an advisory board with 4 advisors, and I got 2 of them to interview with him as well. So I did a bit of a 360, did a profiling, did a referencing, so it did a bit of diligence on that. And but that said, you could still make the wrong call, right? It's never an exact science, but the more angles you can come from, I think, is important, because that is the difference between winning and losing. And you're 100% right. Right now, I can't put the ROI on this guy. It's incredible.
Sam, we're wrapping up here, but I wanted to ask one more tactical question, then one more personal question. On the tactical, so in a consolidation roll-up play, there's always the question of how much to integrate the businesses that you're acquiring, how much to, fuse them with the mothership. And your strategy there has evolved. Walk us through that evolution, how you thought about it before, how you think about it today.
Yeah. So for context, so I've integrated three businesses effectively in a multi-billion, let's say dollar or euro environment, which was hugely painful. And therefore part of why I didn't want to integrate businesses was I recognize that there are always dyssynergies when the PowerPoint says that there are none, and it's all upside. Okay, in a small business context, and the smaller the business, as you very well know, the smaller the business, the higher the risk, the higher the concentration risk of a customer, the higher concentration risk of a key person. So you're integrating businesses, and the key person decides I'm not up for this and leaves. You're kind of really struggling. So what I felt was, my original thesis was, there should be enough opportunity to facilitate collaboration between all of the group companies, because they're doing slightly different trades, slightly different services. So the cross-sell opportunity, the buying contracts opportunity, the different margin opportunities was big enough to focus on that and not integrate. Yeah, so standalone P&L, standalone brands. What we found is we are getting nice traction when it comes to working together on projects or work, which is great. Different brands confuse the customer. So we've harmonized the look and feel. We've kept the different brands, but we've harmonized the look and feel. So it's very obvious that we're part of the same group. But getting traction on best practice in processes, best practice in use of AI, which is a big investment for us that we're doing in that, and asking 4 or 5 people to try to adopt the same thing is just like herding cats. In a small business context, is like herding cats, and I love that expression carries, but it's very, very difficult to get done. And we take far too long to get to market in terms of the new stuff we're doing. So that's the principal driver behind centralizing it. Yes, there is an efficiency play a little bit, but we're not talking millions here. Yes, over time there might be millions, but we're talking about maybe £200,000 or £300,000 worth of benefit by integrating potentially from a cost perspective. But you just give that more robustness. If somebody leaves, you don't need to worry because you've got a pool of people. You give that robustness, but more importantly, you've got that speed to get things done. We want to adopt this new process. Yeah, fine, let's roll it out. You can't do that if you've got 4, 5, 6, 7, 8, 9, 10 people trying to do the same thing. It just doesn't happen. In a small business context, I assumed it would, and it just doesn't. And that's the reason why we've said we keep the brands, we keep the core business separate, but all of the support functions, we centralize that model now, and that's what we're in the process of finalizing.
Great. Thank you for that. Okay, Sam, we got to let you go, but I wanted to just ask you to share what motivates you personally here. We spent some time talking about this in the Acquiring Minds episodes. You have, and it wasn't just the flexibility that you've already told us about. There's something about building wealth that motivates you. Would you share that with this audience?
Yes, happily. So, I have a purpose that is to inspire, influence, empower, and help others. So IIEH is also the name of my personal company that owns part of the shareholding in the group. So what that means for me is to achieve success, because that's also inspiring for others, but also spend a lot of that time helping others. And what we talked about last time was getting to a number in terms of wealth creation that enabled me to impact thousands of lives in a certain region. So it's Thailand, for example, it has a big place in my heart. Spent a lot of time there and with communities and stuff there, and I want to do a lot of good with certain communities there in a certain way. So I want to build the wealth to really make a difference in that part. Not just there, but that's kind of a big component, and that's kind of a big driver for me. I was challenged, actually, we talked about it earlier, I was challenged when I was at a business retreat a couple of weeks ago by somebody saying, well, why are you always talking about this building wealth first and not, and then you can sort of give back? Why are you not doing something beforehand? And hence why I thought, well, what can I do in the meantime whilst I've not created all this wealth, but what can I do? So I put it out there on LinkedIn around just giving my time one day a month to different people who might want help with this journey, or anything from a strategic point of view, financial point of view, buying businesses point of view, people point of view, anything where I think I can add value, and put it out there. And so we did that. And I had my first day a couple of weeks ago, like back to back with meetings. It was really great, and actually probably may have got some business out of it as well for the group, which is nice. But that's something that's truly important to me. And I'm delighted that they challenged me in the end, because I was like, yeah, why am I waiting? What can I do now? And that's what I can do, and that's what I can offer. So that's what I'm doing. So I know a lot of people will say, yeah, they're kind of about the good of other people and whatever. A lot of the time for me, that's hearsay. But for me, it's really, really important. And that plays into, maybe trusting people too much, maybe seeing the good in people too much. But that's what I'm about. And hopefully we can give a great return and build some wealth for investors as well. So, I mean, we talked about the numbers there, but whilst we promised, 4 to 8 times multiple invested capital, for me, I'd be disappointed if it wasn't 20 times in terms of the opportunity that I think exists, because the nature of the self-funding model going forward. We've got to deliver it, but I think there's a huge opportunity to reward those investors as well.
Oh, well, I'm glad we gave you an extra minute to share what your real multiple that you're shooting for is. You're under promising and hoping to over deliver. I heard 8x, and then now I've heard 20x. So that's pretty interesting. And Sam, just on your point about your time, and I do think that the temptation of many people is to think that they'll give away a lot of money after they become wealthy. And there's this sense of tithing, almost, as as you'll see in religions, where you give money as you go, 10% of your paycheck as you go, not at the end once you're already comfortable and rich. And that's kind of what you're doing now with your time. And I also like the way you're giving your time. It's not, at the soup kitchen where you're not adding the most value. You're giving your time, your expertise, your high value, really high value giving.
I would give more financially, Will, but at the moment I'm restricting the amount that I'm taking from the business. Just to make sure that we've got the maximum for growth. So I don't really take much. Right. It's a minimum salary, so it's not. And having come from a corporate career earning reasonable sums, it's a big gap. But that's for the long term.
Great. Well, Sam Turner, thank you for joining us on the Minds Capital podcast. The third interview you've done with me. You're such a good sport. You're always so transparent, always just give great value to the audience. So the third time, thank you for doing this.
No, thank you both. Been really good conversation. Enjoyed it.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.